Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has a gold fund and a Bitcoin fund. He runs Equity Management Associates. He's a gold fund manager, and he runs the Bitcoin Opportunity Fund. Lawrence Lepard, thank you for joining me again.
Hey, Jason, great to be with you. I always enjoy our conversations. You're linked into the DC network, and it's fabulous.
Well, thank you so much for the kind words, Lawrence. We're recording this interview on Monday, May 20th, 2024. The gold price is absolutely on fire the last couple months. It's over $2,400 at $2,426. The silver price has even rallied substantially. I think it hit $32 a couple hours ago. It's down a little bit below $32 at $31.80. I want to get your thoughts on the rally for gold and silver prices in US dollars the last couple months. Why do you think the gold price is rallying now the last couple months with a relatively strong dollar on the dollar index, and the Fed is keeping interest rates relatively high? They haven't given the market any of the rate cuts that the market has said it has wanted.
Yeah, it's a great question, and I think it tells us a lot. I mean, there's a lot of information. As you know, markets are forward looking. They anticipate, where the puck is going, so to speak. And in spite of a strong dollar, in spite of rates not coming down, there's a lot of signal in the fact that gold took out the old high of 2070, which had been in place really for about 13 years, and silver just took out kind of a more recent high of around $26, $27, and of course now it's up and then 30, and now it's at 32. So I think there's a reason that in my mind, the obvious reason for it is that what both of the metals and the markets for these metals are sniffing out is the fact that the U.S. is in fiscal dominance, the federal government is out of control, the U.S. Spending and balance sheet is in terrible shape, and even though we are not ostensibly printing money, they can see where the puck is going, which is to say they know that there will be future monetary debasement as a result of what's going on, and so what these breakouts tell me is that money printing is coming, even though it hasn't happened yet. And this has happened before, by the way. This happened kind of in 2019. It happened in 2020. Of course, it really accelerated after the COVID money printing spree. But I think what the metals are saying is that we expect the Fed is trapped, and that whether it happens tomorrow or in 6 months or in a year and a half, they are going to have to print a lot more money if they want to keep this monetary system going. And so they smell the future inflation that's coming. So that really, to me, and it's kind of a common knowledge thing, Jason. I mean, you and I think, have known this for some time. I mean, at least those of us who are in the gold investment, business, are very, and most macro observers that are smart about this, in my opinion, have seen what's going on and where we're going. But the world didn't know it. It wasn't part of the quote unquote common knowledge. And now you're really seeing that spread. I mean, you're seeing people like Rick Ryder, was recently interviewed. He's one of the senior guys at BlackRock, talking, just outwardly about how bad the debt problem is and how we can't get it under control and what it implies and how those bonds are going to have to be monetized in the future. And when you see guys like that talking about, you see LREN talking about it, you see, many prominent hedge fund managers talking about it. It suggests to me that, the world is becoming aware of, what's happening here and this problem that we've all, sound money investors, have identified. And as they do, the gold assets as a percentage of total investable assets, a very small number. I mean, if you go to my Twitter feed, there's a great chart that I reposted today by Tavi Costa that just showed what a small percentage of investable assets gold and gold mining stocks are. And it's
Is it 1%?
Yeah, it's like 1%. I'll try and pull it up right now to get the exact number. Actually, I don't think he has a scale on it, but yes, it's less than 1 or 2% of total investable assets. A very small number. And when you're looking to protect yourself from monetary debasement and inflation, gold is your go-to solution, your first go-to solution. It was in the 70s. The 70s was the last big bout of monetary inflation. There have been other smaller bouts since then, but and throughout the 70s, gold was the best performing asset by a country mile. I mean, it was up 30% a year, kind of compound annually, and so that's kind of what I see going on here. And the interesting thing, I think the traditional financial types, as we were speaking about before we started recording, the traditional financial types kind of think, oh, gee, look at how extended it is. It's got to come back in. And those of us who understand the underlying dynamics of it are saying, wow, it's broken out and it's got a long way to run. Lots of the credible analysts that I follow, guys like Luke Groman and others, are looking at it and saying, gosh, this is, gold's going to 3,000, 4,000, 6,000, and we're at 2,400. So, I see a lot of upside over the next 5 years in gold.
Like you mentioned, the conventional hedge fund managers, the generalist guys, the ones that went to the big name business schools, top undergraduate colleges, those are Keynesians. So they learn Keynesian economics, they learn business and macro a certain type of way. Their bias is towards deflation in Keynesian economics. So if they see a strong dollar, they see the interest rates, they're like, oh, I'm going to short gold. Oh, I'm going to short commodities. And they really, there was, I think, a really big short squeeze starting in October, November, December. There was a lot of those types of money managers that were shorting the commodities. And I think they just got obliterated on the demand side because, I mean, the demand out of China, the private sector demand. So like the last 2 years, Lawrence, since the Russia sanctions, there's been a steady dollar cost averaging for the non-G7 central banks. But really, I think the big demand increases, spikes have been for the private sector. So China, India, Japan, Asia, other emerging markets, Turkey, many others. They've been buying gold, silver, copper, physical stuff, the actual metal way above trend.
Yes, I mean, I saw some of the numbers about how offsides these guys were and how short, the large short positions that have been built up in paper, and these people have got to be getting their faces ripped off, because it's kind of been unrelenting. I mean, go look at the silver chart. I mean, it broke through 24, 25, 26. It just hasn't stopped. I mean, we're at 32, and I mean, it's going up $1 a day, the last 6 or 7 days. So,
Well,
I mean,
supposedly the Shanghai Gold Exchange only has under 45 days left of silver inventory, and the demand for physical metal is strong. I mean, people like they're raising margin requirements, and that is not stopping the price from going up this time.
yeah, no, they've got a real problem. I mean, it's been suppressed for a very long period of time. Nobody kind of thought this could happen, and here it is happening. And they're waiting. I'm sure there are people even shorting into it today. They're waiting for a pullback, and they're going to be forced to cover at higher prices.
Yeah, so also not only with the solar panels and the other stuff, so there's industrial demand increases out of China with their solar and electric vehicles. And then also like the investor demand. I mean, the investor demand, there's a lot of people in China and India. I think India just imported an all-time high for silver in the last, I think, March. So that set an all-time record for silver imports. So people are buying physical. I guess those are the people that decided I can't afford gold. I'm buying silver instead to hedge currency debasement.
Yeah, I mean, silver is the great. It's kind of poor man's gold because you can buy it on a per unit basis more cheaply. In fact, there's a really great video that I would recommend people Google and on YouTube and take a look at by Peter Krauth, who writes a silver letter and is kind of an expert on silver. And he talks about the demand that's coming and the deficit that we've been running for the past 3 or 4 years. I mean, we've been running, we produce about 800 million ounces of silver a year. I should say the world produces about 800 million ounces of silver a year. And there's not a really big stockpile, unlike gold, where most of the gold is in vaults and there's a big stockpile. Silver gets used. It gets used in solar panels, and the charts he shows on the increasing demand for silver in these solar panels on a go-forward basis are just stunning, to the point where China could be consuming, over half of the silver we produce every year just to make, these panels. And so, yeah, I mean, I don't see it slowing down anytime soon. And I expect that we're going to, I mean, silver is the one commodity that has not really surpassed its all-time high. I mean, silver touched an all-time high on the Hunt Brothers squeeze way back in 1980. And then in 2011, it also touched an all-time high. And these are both around $50 plus or minus. And, we're at 32 now. I can't see how we don't get to 50 sometime this year.
And you have the cost, the ore grades for a lot of the producers are falling. They've been falling a lot every 5 to 7 years, like clockwork for many, many years. And the cost of mine keeps rising. We've seen that with a
That's a
lot.
great point. That's a really great point. I mean, we haven't added any capacity. I mean, there's been no capex available for investment in these projects. I mean, as this bear market or semi-bear market, because we had a bull in the precious metals from 2019 and 2020, but from the peak in 2020 until today, which is 4 years, it's been damn hard to add silver capacity or really any capacity because capital has been so hard. There's no capital going into this industry. I mean, people kind of thought the metals were dead, and so I'm invested in a lot of these silver developers. They try to raise money to build a project. They can't do it. So we haven't increased supply at all. And so demand, I mean, it's pretty straightforward, right? We're running a deficit. Demand is picking up as a result of all this solar, the need for silver to be used in solar, and we're not increasing supply. Well, there's a solution to that, right? Higher prices, much higher prices.
And the prices have to stay high too. They can't be high for just 6 months or 12 months. I mean, it takes way longer than that to go through the permitting process. I mean, you're going to see miners now that had a feasibility study done 12, 18, 24 months ago. They're going to have to redo their feasibility study because the cost of capital, labor, energy costs, all the materials needed to build a mine, all those things are up enormously. So you're seeing miners that wanted to build a mine the last 12 to 18 months, they have to redo their feasibility studies, and the cost to build the mine are even higher.
Yeah, that's absolutely right. And it's, people, I'm not sure who your listeners are, but I mean, listeners don't understand. From the time you discover a deposit to the time you have ore coming out of the ground, I mean, minimum that's 5 years. It could be 10. And so, yeah, it's, and building a mine is a 1 to 5 year exercise. So, and this is why the silver miners that have production, I mean, they've just been going straight up. I mean, go take a look at, I don't know any of the silver producers. I mean, I've got a basket of them in my in my fund, but they're the stock charts are indicating this, and they came off such a low base that they just have much higher to go, in my opinion, because the operating margins, the operating leverage that occurs. I mean, if you have a $25 an ounce ASIC cost of mining an ounce of silver, when you suddenly, I mean, you're just barely breaking even, a year ago, and you go to $35 and suddenly you've got, a nice 30% margin on at a gross level on what you're selling. You go to $50, you're gonna have 100% margin on what you're selling, and so, the stocks are reflecting that. I mean, I've got a bunch of stocks that just look like rocket launches.
Also, with silver, there's not going to be a lot of new silver supply brought online because primary silver mines, a lot of them largely don't exist. And if they do, they're small, like a Silvercrest. The majority of the silver produced is a byproduct. So it's either from a copper mine, a gold mine, or a lead and zinc mine. It's a byproduct.
That's exactly right. That's exactly right. And so, yeah, it's a very exciting time to be an investor in these stocks. And although, we're up 20, in some cases 20 to 50, a couple of cases 100% off the bottom, the funny thing is that's just jacks for openers. I mean, we can go much higher. Because I look at some of these producers and they were selling at 3 or 4 times existing cash flow. I mean, this was cash flow at $26 silver. And so you've got the growth in the price, you've got the growth in their production, and then you've got multiple expansion. So, you add those together, and that's how you get, 5 baggers and 10 baggers, excuse me.
Yeah, so for the earnings that were just announced in the last 3 weeks or so, that was the first quarter earnings, and a lot of the gold miners didn't even benefit from 2,300 gold. I mean, gold for most of the first quarter of 2024, it was around 2,100. So it was in a trading range still. It didn't break out, I think, towards mid to late March. So now, like the second quarter earnings, when the next quarter of earnings announcements, I think we're going to start to see some really big time earnings beats, good profit margins, and free cash flow.
That's absolutely right. And even and twice as much in silver. Do you know what I mean? I mean, it's because as a percentage move, I mean, the gold price is up, right? I mean, gold's 24 up from 2070. That's nice. But that's a 20% move. I mean, I'm looking at silver at 32. It was up from 26. That's an even larger move on a percentage basis.
And then you have companies like Fortuna Silver and Gold that have like a good gold mine that they fixed and got it running smoothly, and then a silver mine. So they have both.
Yeah, that's exactly right. I mean, I look at some of my big holdings like Avino or, Endeavor Silver, or the big ones even. I mean, Coeur, Hecla, Pan American. I mean, to me, silver right now is the most asymmetric in the mining space. It's the most asymmetric bet out there. There's a lot of potential, and you missed the first part of it because it has moved. But I don't think that, if we're going to 50, which I think we are, there's a lot of run still in front of us.
Now, with your gold fund, do you tend to avoid the largest miners like a Barrick Gold and Newmont? I know a lot of the hedge fund managers like Stanley Druckenmiller and some of the other guys that have larger amounts of capital to invest are looking at those. But when those companies report earnings, I mean, the costs just keep rising. It's like they have no discipline. They can't control their costs at all.
Yeah, it's kind of a mixed bag. I mean, Newmont got incredibly cheap recently and took off of that base. The problem the largest guys have is they have a hard time growing their production. I mean, when you're producing 5 million ounces a year, it means you got to find 5 million to produce, to replace what you produced. And it's just the law of large numbers. It's hard to grow a 5 million ounce, producing company, whereas you get a small company like an Avino that's producing a couple million ounces a year, they're going to grow to 6 million ounces a year. I mean, that's a triple. I mean, Newmont's not going to go from 5 million ounces to 15, right?
Well, I hope not. They're going to be producing at like $2,000 an ounce or something if they want
Well,
to.
yeah, exactly. Well, there's that issue too. But sometimes I am in some larger names. I mean, I think they're they got silly cheap. I mean, I look at I'm sorry, I look at Coeur, Hecla, and Pan American, and they were just also silly cheap. That even big names, safe names, have a lot of upside. But I've generally speaking, I very rarely have owned Newmont or Barrick. I mean, there was a time I played it when it was low, and but I'll probably be rolling out of it now as it adjusts back to a more normal valuation level because I think there are other places that have more alpha.
Well, I mean, if the metals price stays at these levels, so if we stay at 2,300 gold or we go higher, or we stay at around $32 silver or go higher, I mean, the rising tide is going to lift all boats. But I think you're
Absolutely.
going to see outperformance in some of the medium sized, the more efficient miners, like you said, because at this point, I mean, Barrick Gold, their costs, they were around $1,000 an ounce only 3 years ago. I think 2020, 2021, they were below 1,100. Same thing for Newmont. And here we are, their costs are around 1,500. I mean, that's just shocking.
Yeah, it's a problem. I mean, and it's also a fact that in many cases those larger companies are mining lower grade deposits. And I prefer to stick with the companies that have higher grades, when possible.
Yeah, shockingly, Lawrence, they actually didn't, from what I heard, these are rumors that Newmont and Barrick Gold didn't seriously bid on the 40% stake that Orion Mine Finance wanted to sell on Greenstone. And that's like one of the lowest, if not the lowest cost mines in Canada that's about to pour its first gold in the next couple weeks.
Yeah, I love Equinox. I just absolutely love it. Yeah, it is kind of shocking, and some people think they overpaid for buying back the piece they didn't own. I completely disagree. I think they got an incredible bargain. It really comes down to whether you're a bull on this stuff or you're not. And I think a lot of the guys in the mining business aren't necessarily as tuned in macro wise as maybe yourself or myself or others. I mean, you have to really understand and believe in the macro. I mean, these guys in the last 3 years, these guys should have been going around snapping up every little junior that was undervalued, but they didn't. They just sat on their hands.
Well, actually, like over the last 15 years, a lot of the acquisitions are actually done when the share price is overvalued and there's a rally in metals prices. So
Yeah,
they kind of.
it's classic behavior. They buy the tops and they sell the bottoms.
Well, they kind of do that with very similar to regular generalist fund managers. So whatever
Yep,
shares or industry. So if artificial intelligence stocks are going up or Cameco shares are up like 3x or 5x already in uranium, then the generalist fund manager adds it for like window dressing, right? But he missed the big move. But they then
that's
tell
right.
their investors in the letter like, "Oh, look, I have uranium exposure. Oh, look, I have artificial intelligence exposure." Well, you missed the move though.
That's exactly right. And I even see it as a fund manager. I mean, I had a great year in 97, or I mean, in 2019, I was up 97%. In 2020, I was up 122%. I had a ton of investors come join my fund, right? Because they wanted to get in on that performance. And I warned them and I said, hey, dollar cost average, there are issues here. We've had when you're up 400%, you're going to have a pullback. And sure enough, we did. I didn't think it would be as bad and as deep as it was from 2020 to today. I mean, I brag about those results, but then I'll tell you, my fund was down 50% at one point off of that peak. But when I was down that 50%, I couldn't get anyone to look at it. I couldn't get anyone. Well, a few smart people added, but in general, I was having a hard time finding new investors. Of course, that was when they should be buying, and that's just that's natural human behavior. You chase results, and then when things aren't working, you get scared and you panic, and you sell. In fact, I had a very large investor who was a perfect contrary indicator. He came in the summer of 2020 and he blew out at the bottom. And I told him he was making a mistake, but he didn't care. He wanted his money back, and so he took the loss. So, it is what it is. It's human behavior, sadly. I mean, if you want to make money in investing, you've got to buy things when they're cheap, and there will come a time that these things will get ahead of themselves, and I will be lightening up substantially. In fact, even today, I've had a couple of companies that have just done moonshots, and I've sold some portion of what I own because they're ahead of themselves.
Yeah, I agree. Even the mining companies are guilty of this, as we said, with the bad acquisitions that a lot of the gold miners did when the gold prices were too high. I mean, there was over $70 billion of bad acquisitions written off. A lot of it was by Barrick Gold, but I think Kinross and Newmont and others also wrote down a lot of the bad acquisitions. You're starting to see this now with the miners outside of gold and silver. BHP Billiton and Rio Tinto, they were buying lithium mines when the price was skyrocketing. So they have all
Yeah.
these lithium mines that they overpaid for. Meanwhile, when BHP Billiton wants to buy Anglo American, they're trying to tell Anglo American to sell all their platinum and palladium mines, which are cheap and hated. They want to get rid of those as part of the condition. I know there's all these counter offers and other bids and spinoffs and stuff like that, but you'd think like they would say like these platinum and palladium mines are cheap and hated. The platinum price is over $1,000 below the gold price. No contrarians out there in the mining industry.
Yeah, you're dead ass right. I mean, it's kind of stunning to me that it is what it is. I mean, and I was around. I've been doing this since '08, and I remember some of those stupid acquisitions that got done in the peak in 2011. I mean, it was amazing. They were all, scrambling to overpay for things, So it just seems to be the way of the world. And on the other hand, for intelligent fund managers who see what's going on and are willing to swim against the tide, you can do extremely well. But there are moments and periods. I mean, I've got to tell you honestly, the last 3 years haven't been a lot of fun. I've had a lot of investors griping, and there were even times when I was pretty much sure my long-term thesis was right, but it sure wasn't showing up in my results. And I had a lot of investor, bitching and moaning.
Well, I think the Russia sanctions really accelerated things. I think we had a paradigm shift starting in 2022, and now like a lot of the foreign central banks, foreign governments that are outside the G7, they've just decided, and Luke Roman has talked about this a lot as well. They're not going to be accumulating a lot of U.S. Treasuries. They're going to be dollar cost averaging each month for increases in net gold tonnage. I think the People's Bank of China has bought 18 months in a row publicly. Those are the numbers. It's probably the real numbers, probably a lot more than that. So I think a paradigm shift the last couple of years has started. And we were talking before we started recording, the US national debt has roughly doubled from 17 trillion to over 34 trillion in the last 10 or so years. Foreigners, so foreign governments, foreign central banks, they have not been net purchasers of even $1 trillion of that doubling of the US national debt.
Yeah, no, that's right. That's absolutely right. The we're seeing this trend. I mean, there's a chart I tweeted again today that showed, the transactions that were occurring in dollars and percentage of Chinese transactions occurring in dollars and occurring in yen or yuan, I'm sorry. And it's kind of stunning the way that, you know, there's a strong movement, and I think Luke has been the best macro guy at pointing this out. There's just been a strong movement, as a result of the seizing of those Russian assets that basically said to the entire world, we just can't store our excess earnings in dollars and dollar denominated things anymore because it's dangerous. And so, he posits, and I think he's right, that what's going on now is, oil being the largest commodity in the world that everyone needs, particularly places like Japan and China. That oil is being, countries are purchasing oil in their own native currency, China in the yuan, et cetera. And then if the oil country has a excess of yuan, they just go to the Shanghai Gold Exchange and convert it into gold, and use that as the neutral reserve currency. And so that kind of puts a bid underneath the gold price.
Do you expect a lot of new mines to get financing in the next 6 to 12 months, or do you think that the market's going to be very skeptical about the gold price and given where interest rates are, cost of capital, that it's going to be very selective about funding new mines, at least for the next 6 to 12 months?
That's a really great question. I don't know the answer to how it will unfold. I mean, they should get financed, and I think ultimately they will. But as I think you pointed out, and I agree, there are a lot of skeptics, and my sense is it's going to take a while until we get into a full raging bull market for this stuff. I mean, gold might have to go to 3,000 before everybody goes, "Holy shit, this is real." back when it was at 2070 gold, the Wall Street consensus, Ronnie Stoffeli had a great chart, great tweet on this where he showed that, Bloomberg Wall Street consensus was that, 5 year out gold prices were going to be $1,800. We were at 2070 and people were thinking there were going to be lower gold prices in 5 years. I mean,
That's hilarious.
it is hilarious. I mean, in my opinion, in 5 years, gold's going to be $4,000 or $10,000. I mean, it's certainly not going to be below three. And so,
But I don't even know if 1800, 5 to 10 years from now, if that'll be an economic price to produce, because I
well,
mean,
that's right. Yeah, that's a good point. I mean, all of their costs are going up as well. I mean, and that's, by the way, that's why. So, in my opinion, that's why everyone said, "Hey, hang on." I mean, I had a lot of investors. They call me up and they say, "Larry, well, let me get this straight. Gold is doing fine, and they're going up, but my gold stocks are going down. Why is that? What's wrong with this picture?" And it was pretty simple to explain. If the market believed that we were going to have future gold prices of 1,800 or 2,000, and the ASICs, as you pointed out earlier in this conversation, were going from 1,000 to 1,500, well, guess what? Their margins were going to fall apart. I mean, and so what needed to happen and what is happening is, the market is coming to realize, oh, okay, yeah, price costs are going up. ASICs have gone from 1,000 to 1,500, but gee, at a $3,000 gold price, 1,500 still works really nicely, right?
Well, the other thing, the divergence, and Larry's talking about the divergence between the gold price and like the GDX, like a gold miners ETF, how there's a huge divergence there, how the miners have not kept pace with the gold price increase. I think the other issue here that explains that is if you talk with people in China, India, Japan, they're not buying gold mining ETFs. They're not buying individual gold mining stocks, at least not yet. So they're buying physical metal right now. So the demand for the metal is there in the private sector. They're buying metal. They're not buying mining stocks yet. However, if you start to see, like, let's say you start to see Royal Gold, which just announced, I think, a 7% dividend increase, or you start to see like Osisko Gold Royalties on their last quarterly call announce an 8% dividend increase. You start to see those types of things. More investors are going to come in and say, hey, I'm going to get paid to wait for the share price to go up. I'm going to get an extra dividend.
Correct. You're going to see buybacks, et cetera. I mean, I think, B2 Gold, I think, is paying a 6% dividend. I mean, it's like, wow, that and trading at a reasonable multiple, and and they have production growth as they bring on their new mines up in the Arctic. So yeah, it's really kind of a perfect storm for the stuff that we own, those of us who are in the mining space. But this is the nature of this business. As anyone who's been in this business in this category knows, it is a tough business. I mean, you're breaking rocks, and it works incredibly well when the gold price is going up faster than the costs. And by the way, it works poorly, and the business is a shitty business if the gold price is not going up and costs are going up. So, the two, you've got to watch both things. I mean, it's the spread between the two. I mean, this is a spread business, right? They've got a cost to get the shit out of the ground, and then they've got a cost that they sell at. And when that spread is getting larger, you can just see profits grow very, very quickly.
Yeah, I cover the mining companies, but they're not buy and hold. So you cannot buy, say, a Newmont Mining or Barrick Gold and hold it for 10 years. If you look at a max chart on those companies, I mean, they've had problems with their margins, cost increasing. Every time they want to grow production or replace reserves, they buy a lot of ounces of gold, but it's at lower and lower grades normally and higher costs.
Yeah, I've always said that gold stocks are something that you rent, not own. But you rent them. I mean, it's interesting. I've observed it over a long period of time, and it seems like the cycles tend to be kind of 3 to 4 years on both the bull and the bear. And so, we had a nice bull from 2018 to or 2016-ish to 2020, and that was a 4 year bull in gold stocks and gold stock prices. And then we've had a bear from 2020 to 2023. And it appears now we're back entering into another bull, and I fully expect that this one will run at least another couple of years. It could, and possibly 4 years. I'm not, it's hard to know exactly how this is going to play out. And as I say, there will come a time when, when this leg up will start to look a little long in the tooth, and the values won't be as obvious. And by the way, I'll probably be lightening up at that point in time. But I think in terms of a baseball game, I mean, we're in the second inning of this bull market, and so we've got some runway in front of us.
Now, I know you buy gold juniors for your fund, silver juniors too. Are they
Mhm.
able to raise 10, 15, $20 million for drill programs? Have they restarted a lot of drilling yet with capital raises? And then,
Not yet. I mean, some have. I mean, even in this downturn, the very best companies have been able to raise capital and continue doing what they're doing, advance their projects. I mean, if they're smart, you haven't gotten necessary unless you have a really great deposit, you haven't gotten paid a lot for drilling. There've been only a few, real drill story successes. I mean, Snowline was one. I'm involved in another one called Lavras, which I think has a lot of upside left in it, but it came up quite a bit off of its base. The development stories, I mean, if they're smart, what they've done, if they've husbanded their capital, if they have a deposit, they haven't spent money drilling because they don't need to. I mean, there's no point if you've got a 3 million ounce deposit, going to spend a bunch more money to prove it's a 4 million ounce deposit. Who cares? I mean, three's good, four, yeah, that's nice too. What they've been doing is they've been working on their pre-feases and their feasibility studies and kind of getting everything ready so that when the financing climate got better, which it appears to be doing, they then would be able to go raise the money and advance the project forward. And I think that'll happen. But as I think we talked about, it's going to take a little bit of time. I mean, I'm sure there's still skepticism in the finance, in the money raising community, and I haven't observed. I don't know. I mean, this stuff that we're talking about has literally just happened. It's months old. I mean, the gold breakout was, I think, in March of this year, so we're not very far from March. So it's going to take a little bit of time for everybody to adjust their mindset to, 1800 is not the future price. I mean, I think when you have a breakout like the one we have, you can pretty much assume that now 2000 kind of has become the floor in gold. We squirted up to 2400 very quickly, and it would not surprise me if at some point in here we have a correction back to 2000 to test the breakout. That's typically what happens. But in my view, that correction would be a big buying opportunity. And we're not. I mean, as everybody's mindset adjusts to we're not going back to 1800, and in fact, we're just as likely to be going to 2800. Then that financing climate will become easier.
well, there's a lot of above ground gold, like you said, but for silver, it looks like a lot of the inventories at the exchanges, whether that's the Shanghai Gold Exchange, physical silver inventory there, the London Bullion Metals Exchange, LBMA, physical silver inventory there is depleted. Same thing with the COMEX. So if the Shanghai Gold Exchange runs out of silver in 45 days with the current demand levels, physical silver, I'm wondering where they're going to source the silver from.
Well, they will. I mean, look, it would, price solves any shortage. We know that. But it's a good point. I mean, there's substantial tightness in this market, which is why we see the price doing what it's doing. But I can tell you, I mean, I've got a bunch of ounces that at $50 I might sell. Um, I think silver's going to 100, 150, 200 over the next 6, 7, 8 years, but it'll be in waves, right? And we're pretty substantially above the 200-day moving average in silver right now. I think we can stretch it even further. I think at 50 we'll probably be a bit too far above, and supply will come onto the market. But having said that, good God, I mean, getting financing to build a silver project, when suddenly the price of what you're selling has doubled because silver was at 25, and probably in the first quarter as an average price, it's going to be a whole lot easier.
It's going to take at least 3 or 4 quarters for the market to start wanting to finance a lot of new mines, though. So we're going to have
That's
to start to see good quarterly earnings. The producing miners show it with their profit margins and the free cash flow, maybe some dividend increases. That's going to attract more investors, more capital raises.
that's that's exactly right. That's how it happens. It's just there'll be just more and more bricks in the wall, supporting our thesis. And as those come in, and there's nothing. I mean, as people tend to chase performance, and I mean, I had a month where I was up, 2 months, I guess it was a month and a half ago, or I was up 25% in 1 month, right? I mean, and so people saw that, and I got a few investors, right? A few new investors, and so people start to see good performance, and they go, "Wow, and, I want to get in on this." And if they look at it, constructively, they can see that we're still in in inning 2 or 3. They're not too late now. A year from now, I won't be pounding the table quite as hard because they won't be getting as deep a value as they'd be getting right now.
Yeah, and also I think with these profit margins, free cash flow, some of these companies that had higher costs, a lot of debt on the balance sheet, if the metals prices stay at these levels or go higher, I mean, you're going to see clean balance sheets 6,
Oh
12,
yeah.
18 months from now, you're going to see some of these companies that were loaded with debt, you're going to see them debt free in sooner than people think.
Absolutely. I've seen the good companies have paid down a lot of debt and have very clean balance sheets. I mean, it's, the one thing about, the 2013 to 2015 experience is that it just scared the hell out of most, mining executives. And there's a lot more discipline in the industry, because if they weren't disciplined, they went BK. And so, the people who have survived through that bear market are now, I mean, I would argue they've been too cautious. They should be more aggressive. But I get why they've been cautious. It's been tough, and we're not obviously in a bull market yet. But I think that we are at the cusp of that obviousness emerging.
Well, I would say the one larger miner, gold miner, that wasn't too cautious was not Anglo Gold Ashanti. It was Agnico Eagle that bought what
I,
Detour Lake and then added the second half of Canadian Malartic, and now they have two of the best five gold mines on the planet. So that's why the shares are trading at such premium, is because during the bear market they were buying quality assets, two of the top gold producing mines in Canada.
Absolutely. The smart big companies have done the right thing. I mean, Calibre buying Marathon and B2 Gold buying Sabina. I mean, both of those were very smart moves.
Yeah, and then you have what Alamos Gold, which has good free cash flow. They just bought Mangino when Argonaut Gold got in financial trouble with their cost overruns on the mine.
Exactly. No, that was a very smart act. I was very disappointed with Richard Young and Argonaut, and I guess it was just too much trouble there to continue on his own. And so I was in it and we made money on it, but it's yeah, he found a home at Alamos, and there, look, I mean, McCluskey, who runs Alamos, is a smart fucking guy, right? I mean, and that's why the majors, the good thing about the majors is generally they're run by smart people, and they know how to pick off the smaller companies when they're in trouble. And at least we got shares for that acquisition. But the problem I have with Alamos, it's not really a problem. I own it, but not in size. It's just that it's big. It's really big, and it's not as cheap as some of the smaller ones. The real alpha is in kind of the emerging middle set of companies, right? Um,
But if they only
no,
have like one or two mines, right, and they're building a really large mine, and then there's cost overruns, the capex problems, the mine doesn't hit the cost numbers or production guidance, the miner can get in financial trouble, and then they have to give away the assets. So that's the risk you're taking. So the upside, like you said, is there's more upside, but there's also the risk that if the miner doesn't bring the new mine that they're building on time and on budget, they bet the whole company on the mine, then you get stuck into a problem
that's
like
absolutely right. I mean, and the perfect examples of that are Marathon, Argonaut, and Sabina. All three of those were kind of in that, as you just described. Fortunately, in all three of those, you got to take shares of the buyer, so you can participate in the benefit of that mine going forward. But there's some other pretty good assets that are, still selling fairly cheaply. I mean, I think Victoria is one that is probably at risk of getting taken out. I mean, that's one of the negatives that you have as an investor in these names, that I get into something and I think to myself, okay, if this works, it's going to be a five bagger, and then somebody comes along and they pay a 50% premium. And look, I'm always happy to buy a stock and have it go up 50%. But if it was going to be a five bagger and I only got 50%, that's kind of a drag. So
or the company that does the acquisition is offering a 50% premium after the shares drop like 20 or 30%. So it's not a
well,
full 50%. Yeah. So there's like shrewd buyers there. I mean, it's distressed asset buying in a lot of the gold and silver industry. Do you think a lot of the producing miners, are we going to see some nice discoveries like what Anglo Gold Ashanti has? They've been reinvesting their free cash flow into exploration drilling. Looks like they just found a 13 million ounce discovery in Nevada with two deposits next to each other in the Silicon deposit and the Merlin deposit. Do you think we're going to see more of that going forward?
oh, absolutely. Yeah, no, there's some great discoveries out there. I mean, full disclosure, I'm a director and a big owner of this, so everybody do your own due diligence. But I sincerely think Lavras Gold is sitting on top of an enormous deposit, and it's a $50 million market cap. I've had intelligent, very seasoned geologists who've looked at it and said this is probably potentially one of the largest gold mines in Brazil. And Paracatu's in Brazil. It's owned by Kinross, and Kinross is an investor, by the way, in Lavras. And Paracatu's 18 million ounces. I mean, this is a 10 kilometer square, caldera. And we've got a 43-101 of 1 million ounces, and we're pretty sure we've got another million easily. And I think this could be a 5 to 10 million ounce deposit, which is worth a lot more than $50 million.
Is it near infrastructure, or is it looking like billions of dollars in capex to build out the?
No, that's really one of the beautiful things. I mean, it's actually in a very good area, and the infrastructure. There's enough infrastructure there. It's a rural area, and there's not. I think they're going to have trouble. They're going to have to bring power in, but there's nothing wrong or bad about where they're trying to develop it. I mean, they're having a problem right now. It's in southern Brazil, and if you've watched, there's a ton of rain in southern Brazil. I mean, Porto Alegre is underwater. In fact, one of the things that's slowed down Lavras is we haven't even been able to meet our drilling program because there's just been too much rain. And so we would have uncovered and reported more gold, but we've only been able to drill half as much as we wanted to drill in the past, 6 months. But that rain will subside and we'll get that drilling done, and so on and so forth. I mean, there's some other another great development story that I'm long on. It's run by a guy I love named Ari Sussman, is collective mining. It's in Colombia, and they're putting up Snowline like deposits. And look, Snowline's a great company. We own it, small, but Snowline's in a very remote area, and it's going to permitting it and getting infrastructure, to build it out is going to be difficult. I look at Collective, and it's got almost the same kind of deposit, size and results, and it's selling at a third of the value of Snowline. It's in Colombia. I don't think Colombia is a bad district. Ari built Continental Mines and sold it to the Chinese for over $1 billion, and right now this a couple $100 million market cap. So, there's some real value out there if you look carefully. I mean, I love Collective. It's a big holding of mine.
Do you think we're going to have to see a sustained higher copper price for more gold and silver supply, because it's a byproduct in a lot of these copper mines? Does that mean that we have to have a higher copper price too for some of these mines to get built?
Yeah, I do. I mean, but we have that, by the way. As you know, copper's breaking out and it's hitting record highs. And as I'm sure we're going to talk about it in this interview. The need for copper to build out all the data centers, as we discussed pre-show, it's going to be enormous. And I mean, it's interesting because this feeds into my favorite copper play right now, which we've got a full position and I've been adding to, which is Arizona Metals. I mean, Michael Gentile is one of the largest investors there. This is in Arizona. It's extremely high grade copper, gold, silver, zinc. And, Gentile told me, he said, look, this thing has got the highest grade copper at the lowest capex of any copper project in the world. I mean, building a copper mine is a big deal. I mean, you can spend between $1 and $2 billion to build a copper mine. All the majors, that have built them will tell you that. The capex on this is somewhere between 400 and 600 million. And at $3 copper, Gentile told me he thought this thing throws off 800 million of EBITDA a year. At $6 copper, double that. The market cap on this company today is $200 million. I absolutely love this company. I mean, it should easily be. I mean, he thinks the $800 million of EBITDA would last for 20 or 30 years. So, what's that worth? I mean, it's worth a lot more than 200 million bucks, right?
Yeah, it looks like there's going to be a huge shortage of copper because China and India, they've been stockpiling way above the normal amounts of copper the last 3 to 5 months. It looks like they understand what's going on with all the new technologies, data centers for artificial intelligence, for Bitcoin mining, electric vehicles. All the new technologies are all going to require enormous amounts of baseload electricity and then copper as well.
That's right. I mean, as you mentioned to me pre-show, I mean, all of what you're hearing from all of the large tech giants is if they want to do AI, it's going to require almost an order of magnitude more power than we've got with respect to running some of these data centers, and these things just absorb copper and silver to a degree. And so the demand picture for the AI trend is going to, in my view, be a very positive thing on a go forward basis.
Now, Bitcoin mining, isn't that similar to a data center? So they have to, it uses enormous amount of baseload electricity. And every time there's a Bitcoin halving, don't they have to, the math problems that the computers in the Bitcoin mining facility, they have to solve harder and harder math problems, which means they use even more computing power newer chips, more electricity, right?
Same story, exact same story. But even without Bitcoin mining, just based on the AI trend, I mean, I was at a Bitcoin conference in Madeira with Michael Saylor, and one of the things that a lot of people say is, hey, we're never going to get to nuclear power. It's just, it appears like there's too much pushback on nuclear power. And Saylor made a very interesting point. He said, look, these AI companies are going to push the governments to go to nuclear power because as a practical matter, it's really the only way we can get to the kind of power generation that we need to fully fund AI. And I thought it was a very interesting point.
Yeah, I've said for a while now that with wind and solar, there's a lot of people that saying like, I don't want nuclear power anywhere near me. I don't want coal or natural gas. Well, you don't really, there's no perfect energy solution. They all have cost benefit analysis, pluses and minuses. But basically, you have to choose if you want an extra $1,000 a month electricity bill or you want cheaper, stable baseload electricity so you can have manufacturing, so you can have the data centers, newer technology, and so you can run your economy at relatively cheap electricity. I mean, unless you want to be Germany, where you get these big spikes with wind and solar, and then some of your manufacturing or your chemicals facilities either shut down or leave the country.
Yeah, you're exactly right. I mean, look, if you look at humankind, through the ages, I mean, we've progressively needed more and more power to support all the billions of people on this planet. And we started with whale oil, and then we went to, we went to oil, and then we went to natural gas. And, the next logical progression is to nuclear power on a output per input basis. There's just nothing like it. It's an order of magnitude step up in terms of power production. And we just have to go there. I mean, if we want to support a planet of 10 billion people, which someday will be, doing it on fossil fuel or doing it on renewables, it's just not possible. And so nuclear is coming. It has to come. If we want to increase and improve our lifestyles. And I think, that's obviously the goal of a capitalist world. And so my view is that over time, and this was the point Saylor was making, is just over time, from an engineering point of view, we will have to become a nuclear world. We'll have to solve all the issues surrounding nuclear, and the regulatory stuff will have to fall away. And these tech giants are going to demand it. That's what's really going to get it done. I mean, Apple, Nvidia, Facebook, all these guys who want to do all the AI stuff, they're going to go to the governments and say, guys, we can't, you want us to do this? Fine. There's only one way to do it, and that is to have nuclear power.
Yeah, Mark Zuckerberg just talked about this on a new podcast. He didn't specifically mention the $100 billion project that Microsoft and OpenAI systems are trying to target by 2030. It's going to be a 5 gigawatt, $100 billion data facility. It's going to be record setting. But there's other projects that are 1 gigawatt of electricity usage for data centers. So that's like basically almost an order of magnitude larger than the current ones. So he's talking about the next generation. I mean, that's going to you have to keep upgrading the processing chips, the microprocessor, semiconductor chips all the time. Same thing for Bitcoin mining, the amount of electricity usage. So do you expect then with Bitcoin mining, the cost to mine Bitcoin, it's meant to mimic, it was designed in the Satoshi white paper. It was meant to basically be similar to digital gold, or that's what at least Satoshi intended. Do you expect then the cost of Bitcoin to keep rising too?
Yeah, it will, obviously. I mean, look, the supply just got cut in half, and every 4 years it gets cut in half again. And so, the cost of mining Bitcoin is going to continue to go up, and that's okay. That's the way it is designed, and I mean, both gold and Bitcoin are forms of money. They're independent forms of money outside of the traditional fiat system, which is, a fraud, as we all know, that are tied to energy. And so the cost of the cost of mining both of those things will continue to increase, and that's okay. And that's why the money will hold its value, because they're backed by energy in a sense. These monies are backed by energy.
So I've seen some of these charts talking about how every 6 to 12 months after Bitcoin halving, the price is up substantially. It's happened after each halving. Do you expect that trend to continue? And a lot of it's because of the math problems that have to be solved by the Bitcoin mining companies and the amount of electricity. So it's basically just required. It's similar to gold mining with the ore grades falling and the other input costs rising.
That's exactly right. I mean, there's a very strong analog. I mean, it's very, it's very parallel to gold mining in terms of the economics of it. You're exactly right.
So we're probably going to see Bitcoin over 100,000 in under 5 years, but a lot of it's just going to be the cost for the Bitcoin miners because there will be no economic incentive then for them to verify transactions and prove what the blockchain, prove out the proof of work with the Bitcoin blockchain network, verify all the transactions without the cost of Bitcoin rising with the cost of the mining costs going up.
That's exactly right. And you know, look, there are two pieces to it. There's the cost piece, which which will go up. But if the cost piece, by the way, went up too much versus the value of the price, well, then the inefficient miners would shut down, and the difficulty adjustment would change, the difficulty of the math problems that they're trying to solve. But I think Bitcoin price goes up. I mean, 100,000 in 5 years. I mean, you got to pump those numbers up, man. I mean, we're going to be at 100,000 this year, and in 5 years, I fully expect we're going to be somewhere between 600,000 and a million per coin. So, there's a great guy on Twitter, Fred Krueger, who's with a guy named Giovanni. They've developed a power law, which is really a very interesting thing to observe. I mean, and this power law that they've developed, they mapped Bitcoin price from inception till today, and they did a log function both on time and on price. And it's amazing. The model they've developed is about a 97% R square correlation with what the price actually did. And you can just kind of see how it marches, year by year. And right now it's the price of Bitcoin. I mean, this is obviously with a lot of fluctuation because we know Bitcoin's very volatile. But if you smooth out this power law, Bitcoin price is going up, 30-40% a year. And so that, you do that math and that takes us into the hundreds of thousands, not that far out.
And you're one of the few people in the gold and Bitcoin community that's actually an advocate for both and diversification. I mean, there's just so much fighting now in between the two
Oh, I
communities.
know.
I'm getting fed up with it.
I am too. I am too. They're both forms of sound money. They're both things the government can't print. Bitcoin has got probably more alpha than gold, but it's got a lot more volatility than gold. There's a complete case for owning both, and that's what I do. I don't think it's, gold is better in some respects, Bitcoin is better in other respects. And, you have to just decide where you want to be, on the different respects, so to speak. I mean, one of the beautiful things about gold is it's a bearer instrument and nobody knows you have it. The Bitcoin negative on the Bitcoin is that you've got a blockchain and people can see where it all is. Now, the addresses are pseudonymous, so nobody knows who owns what. But there is a record of every single transaction from inception, and that turns off some gold people, and that's fine. But I think that anybody who's looking at the sound money bet, which is the bet that I've made, I mean, underlying everything we've been speaking about today is the fact that the federal government is badly out of control. And in my view, we've passed the, what do I call it, the event window where we can't go back. I mean, the getting the federal government in control. I mean, we're well beyond that. The deficits are just too large. The debt is just too large. The interest costs are eating us alive. And so the only, the central banks and the government are programmed to keep the system going. I mean, the fear is always if we tighten up too much and try and calm things down, this whole debt facade completely collapses. And so as a result of that, at the end of the day, they're always forced to print and debase the currency. And as a result of that, you want to own things that the government can't print, basically Bitcoin and gold. And so, these two assets are going to continue to go up in fiat terms for many, many years, or until this debt problem is solved through a one-time reset, which, some have spoken about. I mean, Groman has talked about how we could reset the price of gold much higher, and the U.S. debt to GDP would come in a bit if we actually still own the 261 million ounces that, that the government says we own. They say that they have in Fort Knox. Whether they do or not is open for debate. But yeah, they're both going to work, and so I think that people are well served to own either one of them, based on their preferences. And I personally think there's a case for owning both. I think Bitcoin does have more alpha.
Yeah, I agree. I think Bitcoin's like, in terms of performance, the last like 7 years, Bitcoin's the ultimate risk asset. I mean, it's outperformed on a percentage basis a lot of other tech stocks and other things by a very, very wide margin. However, it's important to be diversified and have a portfolio. Historically, commodities, so not just gold and silver, other commodities historically are the best performing asset classes over long durations of government currency debasement and inflation.
That's exactly right. And and to be fair, the negative on Bitcoin, I mean, it has the highest alpha, but it also has the highest volatility. I mean, there's a great chart in Ronnie Stofferle's recent report that shows the historical Bitcoin drawdowns. And I mean, yes, Bitcoin outperforms after a halving event, which we've just had, which I think is going to cause it to, in this particular run, I think we're going to 100, 150, 200 in the next year or two. But frankly, when it gets to the 200, there'll probably be a correction after that. And corrections in this thing have been severe. I mean, they've been down, 70%. So, one has to factor that in. And, I'm still buying Bitcoin at these prices. I'm not sure I will buy it at, after this, when it gets too far ahead of its moving average, it gets up to 200. I might be selling some Bitcoin and buying some gold, depending upon where gold is at that time. So, it's the way people get hurt in Bitcoin is if they don't dollar cost average and they're not willing to to continue to hold it through the downturn. I mean, I know some people who FOMO'd in Bitcoin at 67, and then FTX came along, blew up, and Bitcoin went to 15,000. They thought they'd made a mistake, and they hadn't. But if they blew it out at 15,000, well, guess what? They got hurt. Now, if they hung on to it, look, it's recovered. It's back to above its FTX high, pre-FTX high, but that took a few years. So, it's a volatile thing, and people need to understand that volatility, and they need to, if you take I don't think there's anybody in Bitcoin who's been in it for more than 4 years who has lost money. But if you buy it at the wrong period of time and you get a drawdown, well, that's, you've got to know what you own and why you own it.
I also think people make the mistake that even if they have Bitcoin, they go further out the risk curve in crypto. So they start buying like altcoins, which are copy and
Oh,
paste jobs of the blockchain code or
oh,
NFTs. The last cycle, 2016, it was initial coin offerings. So they get greedy and they start going further and further out the risk curve. It's like buying some of the worst junior mining stocks when you don't know anything about the mining industry.
that's absolutely right. I mean, there is no, in my opinion, my humble opinion, there is no reason to own any crypto other than Bitcoin, Ethereum, all of them. There's just no reason to own them. I mean, some of them have interesting use cases, but they don't have the monetary security that the Bitcoin network has. I mean, Bitcoin is the largest by far, and there's Metcalfe's law applies. It's the leading network by far, and there's no need to dabble in all those other things.
Well, especially if they're just copy and paste jobs of the Bitcoin blockchain code. So they're not offering any type of innovation with cybersecurity or, anonymous, being able to buy things online anonymously or anything like that. So it's just a bad copy and paste job of the blockchain code without a network effect.
But, well, yeah, and it's even more than that. They don't even have the same construction that Bitcoin has. I mean, Bitcoin has proof of work, and the miners over, and an enormous hash rate that, I mean, there are very few other, coins that are operating on proof of work. And, most of them are operating on proof of stake. And what that leads to is, like an Ethereum, as an example, has had 6 different monetary policies. I mean, it comes down to what Vitalik thinks he wants to do with it, and they're always diluting it. It's kind of like a fiat crypto.
Yep.
Whereas, the nice thing about Bitcoin is there are 21 million of them. That's it. There are never going to be any more, and nobody can change that. And so that scarcity is what lends the value to Bitcoin. In the same way that there's only so much earth in the world's crust, and guess what? That's not going to change. And that's what gives both of these the quality that make them a sounder money than fiat currency. Of course, that's not a very high hurdle to jump over because fiat currency is pretty shitty. But these things
Well,
are obviously much sounder.
yeah, all these governments are doing stagflate tax line now. It's not just the US that's doing it. It looks like almost all these major central banks are going to be letting the real inflation rate run hot, run above the bond yields on the government debt, and they're going to be monetizing debt. So
They
printing new
have
currency.
to. They have to. I mean, the alternative, the math just doesn't work otherwise. I mean, it's that or let the whole thing collapse. And
Well, you could fire government employees and cut the size of government, but I don't see any government wanting to voluntarily do that.
well, that's right. That's right. I mean, there actually is there's theoretically a way backward, but boy, it would be very, very, very painful.
I
You
would
know,
tell you there's almost zero chance of that here in the Washington, D.C. metro area. You have key politicians and their lobbyists and aides and stuff like that in both political parties, and no one in power here is talking about spending cuts. They're oblivious to the interest payments on the debt. They're talking about their projects. I mean, they're talking about funding what both sides of new wars and infrastructure. The Democrats want to still push through more bailouts. I think Fannie and Freddie were talking about getting into the home equity loan
I
stuff,
saw
which
that. I thought that was fascinating, right? I mean, just another way to create more debt. Yeah.
well, I mean, if Fannie Mae and Freddie Mac start buying home equity loans, I mean, they could stick the toxic stuff in there and just let it expire, or they could start giving out loans to hedge funds or private equity to buy the distressed debt after it's written off.
Yeah. No, that's exactly right. I mean, yeah, there are all kinds of little micro things going on that are just fascinating. I mean, we haven't touched on them, but I mean, you've got the Japanese yen falling. You've got interest rates in Japan, going up. And Japan, as we all know, is the most highly levered country in the world, with an enormous carry trade, which is fragile. You've got MBS traveling to Japan to talk about, I assume, to talk about selling gold or oil to the Japanese in yen terms. And if the Saudis aren't going to buy enough stuff from Toyota and all the other Japanese exporters, then I suspect what they'll do is they'll cash settle that yen and immediately convert it into gold, probably in Dubai. And so, yeah, there's no doubt that that kind of stuff is coming, and it's a hell of a world. I mean, the other thing I thought was very interesting, you probably saw it, was that Janet Yellen talked about we're talking to the Japanese about offering them swap lines for the dollar, and that's obviously because they're having trouble with their currency being weak. That makes oil in dollar terms more expensive for them, and so they're having a hard time getting dollars. And of course, one of the things they could do is they could sell the treasury bills or bonds that they hold in order to raise dollars to either defend their currency or purchase oil. But I think in both of those cases, that would shove U.S. interest rates up and make our fiscal situation worse. And so, obviously we don't want to see that happen. And that's why, Yellen is talking about swap lines. I mean, the people who are running the system, Jason, they're doing everything they can to keep themselves in power and to keep the system going. And the release valve is monetary debasement and inflation. That's the release valve. And so, the people who say that we're going back to 3% or 2% inflation, I mean, they're just dreaming. They're absolutely, they're delusional, because we just can't. I mean, Biden recently proposed a $7.3 trillion budget for the federal government next year. It was like a 13% growth. I mean, how the hell are we going to pay for that? I mean, the economy is only growing at 3 or 4%. I mean,
I
it's
think they printed it. I think they're lying about the money supply numbers. I
well,
mean, look,
yeah,
the student loan debt bailouts, there was a 150 billion minimum. I've seen
yeah.
estimates that is way more than that of student loan debt bailouts in just the last 3 years.
Yeah, no, I think that's right. I mean, yeah, there's probably stuff they do off balance sheet that we don't even know about. I mean, one of the things I find very interesting is that they reported a deficit of around $2 trillion last year, and yet the debt went up by 3.6 trillion. So what happened? Was there 1.6 trillion kind of off balance sheet or off income statement? I mean, we all saw it, and it was in my last quarterly letter, which I encourage people to read. It's on my website and it's free. We had $1 trillion of debt was added in 100 days. So if that run rate were to continue, that would suggest that we're growing our debt by $3.65 trillion per year on a $34 trillion debt. So our debt's going up at 10% a year, where our GDP is only growing at 4% a year, which means there's no way we can service that debt. I mean, we are running into a sovereign debt crisis. That's what's going on, in my view. And in a sovereign debt crisis, we've seen these before. We've seen them in smaller countries. We haven't seen one, in the world reserve currency, probably since the days of Rome, when maybe the Roman, denarius was the reserve currency. But, what we know is that when you have a sovereign debt crisis, eventually the currency, falls, either inflationary, highly inflationary, or perhaps even hyperinflationary. And so countries that have behaved the way we've behaved in the past, where they're printing money to pay for their debt, they're printing money to pay for their interest. I mean, they've always had currency events. I mean, Venezuela, Weimar, Argentina, Israel. I mean, you go through it. There have been so many high inflation / hyperinflations in the last 100 years. and they all exhibit the exact same characteristics of behavior that the US is exhibiting right now.
Yeah, I see problems with all these fiat currencies. It looks like the central bankers are all doing very similar playbooks. Like you said about Japan, they spent $60 billion on a yen intervention for 2 days. And the return on investment to manipulate the currency exchange rate for 2 days, it was very, very bad. So they still have similar problems. China just sold, I think, $400 billion worth of US treasuries. So they're way below $1 trillion of total US treasuries now. It looks like they needed the dollars and they went and bought a lot of commodities, a lot of copper and oil and gold tonnage.
Yeah, one of the things that's very interesting, I think people aren't aware of is people say, well, hang on a second, how money supply is not growing. M2 in the US isn't growing that much right now. And it's turned back up again because they ran down the reverse repo facility. But the money supply in the US is not growing. Certainly it's not growing the way it grew during the COVID crisis. But you know where the money supply really is growing is in China. If you go look at the charts of Chinese monetary, it's amazing. I mean, they're printing like crazy in China. And as you say, they're doing a smart thing. They're printing money to buy commodities. That's smart. I mean, that's the Hugo Stennis trade, right? That's what Michael Saylor is doing at MicroStrategy. I mean, he's converting fiat into sound money. And the Chinese are doing the same thing. I mean, and they've been doing this for years. I mean, they've been investing in ports, they've been investing in copper projects, they've been investing in commodities. I mean, and by the way, the Russians are doing the same thing. I mean, the Russians stopped buying our treasury bills a long time ago. And of course, then they had a bunch of them seized. They also have been buying gold, and China and Russia have been the two leading China and Russian, central banks have been the two leading purchasers of gold over the last 10 years, and I think that trend is going to continue.
Yep, until whatever the next system is. So I don't know what the BRICS currency, if it's going to be partially gold backed or there's going to be a system reset, a new global financial system. No one really knows for sure what the next system is going to look like. But this fiat currency system, it's being abused by the governments and central banks in power. They're doing bailouts to large banks and corporations or special interest groups. And unfortunately, you have like the people in DC. I mean, they don't care what the real inflation rate is for the small business owner or regular Americans. They don't care that the real inflation rate's above 10% because they're getting rich or getting rich quick or getting richer. Nancy Pelosi made $20 million in the last 12 months trading stocks on inside information.
Yeah, yeah. No, don't get me started. I mean, it's all pretty disgusting what the DC people are doing. I mean, how does Elizabeth Warren on a law professor's salary and then on a senatorial salary, how does she become worth $60 million? I mean, the only logical explanation I can come up with is corruption.
Well, you keep your mouth shut. So if you win a congressional seat here in the House of Representatives and you play ball and you keep your mouth shut, you can go from worth almost zero or negative with all your student loan debt to $5 or $10 million very, very quickly. That's how the game works. The corrupt, rigged, immoral game here in the Washington, D.C. metro area. It's been that way for decades. It's only gotten worse the last 15 years with quantitative easing, central bank balance sheet expansion, and then about 15 years of zero interest rate policy. That's how you get to, like Larry said earlier in the interview, where the government's projecting to run fiscal 2025, $7 trillion of spending. They're not even counting the interest payments on the debt for that, Larry. So that's
Yeah.
way more than 7 trillion.
Yeah, no, that's right. That's the biggest problem. I mean, I think the other, if anyone looks at the chart, I would encourage people to Google a chart on, U.S. federal interest expense. It's going parabolic. I mean, we're running at about a $1.2 trillion rate today. That's more than we spend on defense. And that's with an average interest rate in the threes, whereas a lot of the short-term bills and bonds are trading at 5. And so as more and more of that debt rolls off and we have to refinance the 3 at 5, I mean, I've seen people who projected, I think credibly, that we could have $2 trillion in interest expense. We only collect $4.8 trillion in taxes. We've got Social Security, we've got Medicare, we've got defense, we've got everything else we spend money on. I mean, it's just deficits as far as the eye can see. And back to the beginning of the interview, I think it's the world becoming aware of that issue and that problem. I mean, this is not something that people were aware of 5 years ago. Well, 5 years ago, people weren't even aware of inflation and the underlying inflation, right? But COVID woke everybody up to that. Right. I mean, when we got a 9% inflation print, I don't think there was anybody in this country who didn't realize, oh my goodness, we got a real problem here. But I think, but then Powell tightened things up and everyone thought, all right, we'll go back to where we were. Inflation will go back down to 2%. And, this was just an aberration. It was just it's just a virus, and everything will be good again. But I think what's happening now is everyone's feeling, well, you know what? Everything's not going to be good again. There's a fundamental flaw in this whole model. And I think, you've seen it, those of us in the sound money community, we've known about it for 5 years. But what I think is happening is the rest of the world is figuring that out.
Yeah, we finally hit where the math doesn't work, whether it's Japan or the US, European Union, a lot of emerging markets. There was almost a debt default that US and China had to sit down with a lot of emerging markets back in February. There was a BNN Canada article on it. I don't think the US even bothered to cover it. But I think inflation, stagflate, tax light, inflation is the new normal going forward. And a lot of people are finally starting to recognize that the math just doesn't work for the budget deficits. It's a supply and demand issue in treasuries. And that's good for commodities, especially gold.
Yep, that's exactly right. It's as simple as that. I mean, it's as simple as that. And so, what is it they say? I think it's Jim Grant said, successful investing is being right about something early, and then everyone else comes to agree with you. And I think those of us who have been in the sound money community, we've been right about this for a number of years. And we're now kind of at that tipping point where the rest of the world is coming to see what we've been talking about.
Yeah, I think a lot of the money that would have went in the past into a lot of types of treasuries like TLT, long bonds, it's not going there at anywhere near the levels. And
Oh God,
like,
no. I mean, the bonds have been an outright disaster. I mean, I looked at a chart today that showed, tips. I mean, and a lot of long bonds have lost 40 or 50% of their value. I mean, this was supposed to be a secure place to put your money, and they've just gotten destroyed.
well, that's what governments, when they have too much debt, right? Historically, that's what they want to do. They want to inflate the debt away. But a lot of the people for years on financial YouTube and elsewhere, a lot of these former bond fund managers at banks, I mean, they were pro deflation. They're not talking about deflation anymore. They're not talking about the losses on TLT. They've stopped talking about that. I think a lot of them are just talking about, oh, I'm making an easy 4 point, almost 5% on T-bill and chill, but they're ignoring all the losses they had on TLT and their leverage long bonds.
Yeah, no, I mean the 60/40 portfolio, it's been a mess. Now the bonds have worked, I mean the stocks have worked out okay. And arguably we're in a crack up boom here, but stock market to me is a mystery. I'm not quite sure, I thought we would have had a correction, but now we haven't. And I think it's as a result of the fiscal behavior on the part of the government. I mean, we're just
Well,
um,
also flight capital, Larry, because you had a lot of Chinese investors, and they've given that there is a rally in Chinese stocks the last month or so, but a lot of that's foreign investors. It's not domestic Chinese investors. A lot of domestic Chinese investors have been out of Chinese stocks and Chinese real estate for the last like 6 months, and they've been buying U.S. stocks. They were paying a premium to net asset value for access to the Mag 7. They're also buying physical gold because of the capital controls.
well, that's right. Yeah, no, that's absolutely right. I mean, yeah, it's an environment that's tricky, and it's particularly, the natural human tendency is to project what's worked in the past will work in the future, and it's not a crazy idea because trends do tend to last a long time, and I think every stock investor who's been involved in the U.S. stock market since 2008 has been trained to buy the dip, and guess what? It's worked out. I mean, the stock market is very close to all-time highs, and if not at them right now, and so. I mean, it's going to take a real punch in the face for people to realize that, buying the dip may not always work. And, stocks are not cheap. I will say that. So, I certainly, I mean, stocks are a much better choice than bonds, obviously, because whatever the currency is, they will reprice in the new currency. But and they represent the earnings power of a business, in some cases a monopoly business. I mean, Google's a monopoly, Apple's a monopoly, Microsoft is arguably a monopoly. Those are good businesses, and but you're paying for it, and in a real severe economic downturn, the premium can come out of stocks. And another chart I retweeted was I had comparison of stock returns to gold returns. And this was on my Twitter feed, and it just showed how, when stocks come, I mean, gold tends to be very nicely anti-cyclical with stocks. And when stocks go down, gold tends to go up. And so to the degree that we do have a downturn in the stock market, that's a net positive for gold, in my opinion.
Now, for Equity Management Associates, do you have a newsletter that covers some of the juniors that your fund
I
buys?
I do. I don't generally speaking, because it's proprietary. I don't generally speaking talk about all the juniors. I do these interviews. I occasionally mention some of the good names I've gotten. I'm happy to share, on a general basis. I mean, the problem is I can change my mind on any of these at any time, and everyone I think should do their own due diligence. What I say is not investment advice. But the letter does talk a lot about the macro picture, and the letter is free. And you can even sign up for it and just get it every quarter. If you go to the bottom of my website, there's a place where you just put your email in, and you'll be on our list and you'll see it. And all the past letters the last 10 odd years are on there, so you can get on there and download them. But I highly recommend that people do that, because if you want to hear my views, because every quarter we update our views. I have a partner, David Foley, who's an excellent guy, and we basically are laying out the thesis and talking about how we are approaching it. And that website, just so people know, is EMA, Edward Mark Alpha. It stands for Equity Management Associates, the number 2.com. And as I say, these things are free.